Hey everyone, it's Rob B here with Rob D, and it's halftime. The year's data is halfway through. We look at what's happened so far this year, and some of the numbers may surprise you. We then look to the future and predict what the rest of the year may bring us. And then, for some reason, we also look at our predictions and what we said would happen this year as well, and assess that against the data. It's a great episode.
Welcome to the Property Podcast. In case you don't know, we run a business that arranges more than £100 million worth of property deals on behalf of our clients every year. You can find out about that at propertyhub.net/invest. So it's always a bit of a concern when we have to put our reputations on the line and make predictions, and even more so when we have to review how they're going. But we're going to do it anyway, and we're going to do it for you, because there's lots of lessons to take from how 2026 has gone so far compared to how we thought it would go. And we're going to share how we think it's most likely the rest of the year is going to play out. So do stick around.
So it's time for our news story of the week now. And the headline story this week is the Bank of England have held rates again, which on its own doesn't sound that spectacular, Rob. The rates are held at 3.75%. But actually there was a bit of movement in the voting from last month. So that's interesting. And then what happened with the mortgage market as well was also a bit interesting, which we can cover in a minute. But first of all, let's cover the Bank of England. They held the rates, Rob, but there's more to it than that.
Yeah, because it was not unanimous, and it wasn't close to unanimous. So of the 9 members of the committee, 6 voted to hold, but 3 voted to increase rates from 3.75% to 4%. They are worried about inflation. They're worried about inflation in general, and they're worried in particular about energy prices and the US-Iran conflict. And I'm never sure quite how genuine all this is, because in reality, I think they're reasonably comfortable with inflation being moderately above target. And they certainly don't want to run the risk of damaging the economy by hiking rates too high. I think that's probably the greater threat at the moment. But nevertheless, their job is to deliver this inflation target of 2%. So they need to be looking like they're trying to do it. So all this to say, will rates go up next time or at any point this year? It's possible, but far from guaranteed, in my opinion. But regardless, Rob, the reason we care about this is mortgage rates. And mortgage rates are not based just on what the Bank of England does, but on expectations of what they're going to do.
And I think the mortgage market was confused by the Bank of England because on one hand, you had the number of people voting for a rate rise going up from 2 to 3 people. So some of the lenders have increased rates. But CPI, the measurement of inflation, has actually fallen, and that's down to 2.6% now. So when you look at the information that's present, there's a bit of confusion on which way it could go. So as I said, some lenders have increased the rates, but some have cut the rates as well. So what should you do as a buy-to-let investor if you're going through the process of investing right now? I would say relax. Overall, it's not had too much impact. It's not like they've all surged up or they've all surged down. It looks like the mortgage market hasn't known what to do with this reading. So there's been a bit of movement around. And I think the competition will keep adjusting it over the next few weeks anyway. It'll probably end up where it was before the vote happened. But the good news is everyone's going on holiday. Well, certainly the Bank of England anyway. There is no rates announcement in August. The next one will be in September. So that also gives the mortgage market a time to calm down and rate stabilise as well.
So here we are in the middle of summer. January feels a long, long time ago, but it was roughly half a year ago. And that means it's time to revisit the predictions we made at the start of the year. As always, in January, we went on the record saying what we thought would happen with house prices, rents, interest rates, the works. And the good news is we can't be wrong yet. We've still got the rest of the year to go. But the reason why this is a good time to check in is it's worth seeing what's happened. Has anything fundamentally changed in the market over the last 6 months, which affects what we think is going to happen and therefore, by extension, could change our behaviour? So Rob, we'll go through all our predictions. We'll throw in what the experts said as well and see how they're getting on. And we should probably start with the big one, house prices.
Yes, house prices. So before we reveal where we're at with Nationwide, let's quickly give you the run through. So the experts, Capital Economics, said the market would be up 5% this year. Remember, these are all by the end of the year, not the halfway point. Hamptons, they had a couple of numbers delivered. They readjusted them, but it was either 3.5 or 5%. Savills was at 2% and Zoopla was at 1%. And then good old Rob and Rob, what did we say? Well, Mr. Dean, you went for a 3% increase and I said somewhere between 2.5 and 3.5%. And where are we at this year to date? So the first 6 months of this year, well, according to Nationwide, we are up by 0.8%. You may, if you go and search for the Nationwide numbers, see it up by 2.2%. But remember, that's the trailing 12 months. We're looking at the year of 2026. And so far, in 2026, property prices are up by 0.8%. So at the halfway point, Rob, we are seeing a number based on the market sentiment that we've seen that is probably expected. Where it will end up by the end of the year, probably a little higher, I would say, all things being well. Will it get as high as the lower range of my prediction? I certainly hope so, because I love being right. But it's way off currently from where Capital Economics and Hampton said things would land. And Savills, Zoopla, and then maybe, good selves, could be in the range of being correct by the end of the year. But what's more important than who's correct is where we're at. And I think it's interesting that it's still a positive number. You could say in real terms it's fallen, that being that inflation is higher than house prices. But still, in nominal terms, it is still up. And I think if you'd only read the news for the first 6 months and hadn't seen any of the data, you would have said house prices had cratered.
Yeah, and it is region specific as well. So we'll come to cities in a minute, but there are some parts of the country and some segments of the market where prices are down, but it's being held up by more resilient markets elsewhere. I think there's a chance that we'll luck our way into the bottom end of the band. But what we were saying back in January, it didn't feel like we were being particularly ballsy at the time. That felt like a fairly safe range. But I think if we're looking back over the year, it was really end of February, beginning of March, when things really fell off. Rates picked up, sentiment went from poor to really, really apocalyptically poor. And on the flip side of that, our business, Property Hub Invest, started doing some phenomenally good deals because so many other people had decided to step back. So I don't know. We've already seen that a lot can change in half a year. A lot could still change in other direction, but there's a chance that our prediction will end up looking respectable come December. Now, Rob, historically, our strongest predictions have been around that regional point I was talking about earlier, and cities in particular. And if I had a quick look at the data, it looks like, once again, we're on our most solid ground here.
Thankfully so, because this is kind of our main bread and butter, right? It's like sharing where the value is, helping people see things that aren't obvious, sharing the extra insights that we're lucky to have. And the cities that we picked, well, we both picked Liverpool, we both picked Newcastle, we both picked Manchester, we both picked Leeds, and then individually, I picked Sheffield, and Rob, you picked Birmingham. And all are beating the average, and in some cases by some way. Liverpool is actually up by 4.6%, the top performer in the whole of the UK. So I'm very glad we picked Liverpool. Newcastle up by 3.6%, Manchester 3%, Sheffield 2.6%, Leeds 2.5%, and Birmingham 1.9%. Now, when we do our house price predictions, we pick the cities from England and Wales because they're the countries that we operate in. And Liverpool is number 1, Newcastle is number 2, Manchester is number 3, Sheffield is number 4, and Leeds is number 5. So, wow. I mean, I had to say, can we stop the year here, Rob? Because I've got all 5. I think I normally get maybe 4 out of 5, but the good news for you is number 6 is Birmingham. So you're not doing too bad either. You're not exactly disgraced yourself. So it's a good pick from us so far. We will see where the year ends, but we're not surprised. I think that's the most important thing. Whereas maybe some people may be surprised by the number being up this year for overall UK property prices, some of these areas are very healthy in terms of capital growth levels. Liverpool, 4.2%. These are annual changes, I must say. So these are the trailing 12 months. And we'll see what happens when we're looking at just this year's data. But so far, so good. And none of these places, clearly, because we predicted them at the end of the year, are a surprise to us that they've performed so well.
No, this is the easiest of the lot because it really is just, well, where is the relative value? And it's just so clearly concentrated in certain parts of the country. And then you pair that up with the ripple effect and you go, well, growth tends to go to where the jobs are, where the infrastructure is, where improvements are happening, and then ripple out from there. And the regional divide is so strong at the moment. I can't remember it ever being anywhere near as pronounced as this, that it's probably never going to be as easy again as to make accurate city picks. But nevertheless, I don't want to detract too much from our achievement. Still happy that that's going the right way. Now, a trickier one is rents, because the backdrop to this is that rents spent a couple of years going absolutely bazonkers. So you had double-digit rental growth, a really acute shortage, and rents were just going crazy. Then that was moderating. So coming into January, like, okay, clearly the trend is rents rising, but rising less fast than they were. But where is it going to land? We both ended up picking the 4 to 5% range. The experts went a bit lower. So Hamptons said 3.5%, Savills said 2%. And at the moment, it pains me to say the experts are doing better than we are. So year to date, it's roughly 1.6% so far. If you look at the last 12 months, the ONS shows rents up 3.3%. So that's coming in below our 4 to 5% range. A couple of interesting deviations within that overall average. One is that renewals are doing better than new lets. That is the complete flip of what we were seeing for a few years. We were seeing rents on new lets going up way faster than within tenancies, which is kind of what you'd expect. But I think because of renters' rights and everyone suddenly deciding to get their act together and put their rents up, combined with supply and demand in the rental market coming back more into balance, we have seen that completely flip. And then the other interesting point within there for me, Rob, is once again the regional picture, where there is a huge divergence between best and worst. So London over the last 12 months has put on 2.2%, not bad, but the North East, 6.3%. Again, it's just obvious, right? It's just prices go up where there is room for them to go up and where the value currently is.
Rob, it's so true. And actually, we spotted a deal recently for Property Hub Invest, which is outside some of the areas we normally talk about, but the yield was so strong and the fundamentals were so strong that we were like, this is crazy. It's clearly undervalued as an area. I don't know, our clients are absolutely loving that. It's just a simple play, but so many people don't look at property that way. That's why we've had some success with picking the areas, because it's just spotting where the value is and looking at the yield of those areas plus the fundamentals is quite a simple way of achieving that. We've got an interesting episode coming up, which will probably go out at the beginning of next month, where we look at the concept of value investing within property. So I'm sure you'll love that one. If you have not subscribed to this podcast, and this is just a one-off for you or an occasional thing, make sure you are properly subscribed so you do not miss that episode. It's going to be a really good one. So moving on to the base rate. We talked about that at the beginning of the pod, but let's just remember where we started the year. Back in December 18th, the Bank of England moved the interest rate from 4% down to 3.75%, and that is where we have remained for the rest of the year. Yes, as we talked about, there's been a bit of voting, a bit of movement there, but it hasn't moved, and not as much as people expected. Capital Economics thought we'd end the year at 3%, same for Goldman Sachs. Rob, you were at 3.25%, and I was 3.5%. Now, I have to say that, to be fair to everyone in that group, and it looks like I'm the closest, but to be fair to everyone else, these predictions were all made before Donald Trump got involved with the whole world. And there's the wars that have subsequently happened and the volatility as the result of that. So because of all that, I do think nearly everybody should be given a pass, even though it makes me look the best at the moment with the predictions because I'm the closest. So it could have taken an easy victory there, Rob. But I think in fairness, I think it was perfectly reasonable to expect that the interest rates now, and now being that we're at the beginning of August, would be lower than where they started the year. But they have held. Will they drop at all before the year ends? That is the big question.
It is. And the bigger question is, will they drop far enough for anyone other than you to be right? I'd say that's probably pretty unlikely, because that would need at least 0.5% from here. And I think really this ties back into what I was saying earlier. The world, the markets really have changed significantly over this first 6 months. And that has affected house prices, like we saw earlier. And that has affected interest rates. And of course, house prices have been affected via interest rates, among other things. So I think really that shows that, yeah, making predictions is fun, it's interesting, it can be informative, but really you need to have an investment strategy that works over the long term and doesn't get completely derailed if someone randomly decides to go to war, for example, because who knows what's going to happen in the short term. But Rob, hopefully you know what's going to happen in the short term, because I'm about to ask you, given everything that we've learned in the first half of the year, What do you now think we can expect in the second half of the year? Because, yeah, I've just said you need to have a strategy that works and plays out over years, and that is true. But nevertheless, there are people who need to make decisions today. There are people who are getting into property. There are people who are deciding about expanding. They're deciding what to do with remortgages. So they're not going to be satisfied with, oh, yeah, well, anything could happen. What do you think is the most likely to happen over the second half of this year?
Rob, I'm sure people now are waiting for something big and juicy, but I'm going to be so boring because I actually think not a lot will happen for the rest of the year. I think the maximum we'll see in interest rate changes be one move. I actually think more likely down than up, but we will see. I think property prices will be a bit higher than they already are now. Rent inflation will be a bit higher again than where it is now, but not in a dramatic way. I think our city picks are pretty solid and they'll be there or thereabouts, so they'll be fine for the rest of the year. I think it's going to be a little bit better than the first half of the year, but not suddenly where everyone's going mad in the front pages of newspapers or talking about property booms. Just people have got used to the world that we are in right now, which always happens when there's big change. You have volatility, things tend to settle down. People are getting used to the status quo. They're used to interest rates where they are right now. Yields continue to improve. Property prices aren't moving that much in real terms. When you look at them against inflation, they're falling slightly. I think it'll just be a bit more of the same with a slight, tiny uplift before the end of the year. And then we get into next year, and maybe then there's time for something new and more exciting to happen. But for the rest of this year, more of the same, just a little bit better than it has been so far. Sorry, Rob, can you be a bit more sensationalist than that?
I'd love to be for the podcast. I can't get to anything super dramatic, but what I can say is, as we've seen this year and as we've seen at some past turning points as well, things can change very quickly. And a lot of the muted, let's say, market that we've seen so far this year is around sentiment. Yes, interest rates and rates being higher than expected are certainly a part of it, but there is also this blanket of negativity across the market, the country, the world, I don't know, and sentiment can change just like that. It doesn't necessarily need months or years to slowly turn things around. So while I don't think it's particularly likely to happen, I do think there's a possibility of a more dramatic change from here. And if there is one, I'd say it's more likely to be to the upside than the downside, purely because so much of the downside is known and priced in and expected. But if for some reason there is a change of sentiment, then you could get a surprise to the upside. So that's as close as I can get, Rob, to something a bit more exciting, which is really just acknowledging the possibility, because at heart, I think you're probably right.
But it's interesting, right? Because people listening to this would probably be thinking, well, I hope Rob D's right, because that sounds a bit more positive and upbeat. You want me to be right, because what I've said to you is more of the same. Well, what do we have? We have a market that's ticking up in the slowest possible way in terms of property prices, but you have rents and yields that continue to improve. And you've got sentiment, which is low. So what you have are buying opportunities. You don't want to be transacting in a hot market. That's not what you want. You want a market that you believe in long term, but that offers great opportunities short term. And it's hard to get your head round because people are so negative. But if you get your head round it, then it's amazing. So it sounds like I'm being doom and gloom, and what I'm laying out for the rest of the year is not great. Maybe overall for the country's morale, the economy, it's not great what I'm saying. But if you believe in the fundamentals of property long term, which you pretty much must do if you listen to this podcast, and then you understand the opportunity short term, you absolutely want my prediction to play out.
Well, that's right. But before we end, I'm a bit concerned, Rob, that our predictions haven't been looking so great so far. People might be losing faith in our general aura of omniscience. So let's share one prediction we made where we don't have to wait till the end of the year. We already know what has happened. And this is the important one, the World Cup. And the great news is we got second and third. It's not bad, is it?
Yeah, it's not bad. It's not bad. We predicted that the winner would be, well, in your case, Rob, Argentina or England. And I went Argentina or France. So that isn't bad because we got the runners-up and then we got the third and fourth playoff as well. And you know what? I'm very glad I'm wrong because I'm very pleased that Spain beat Argentina in the final, as I'm sure a lot of other people were as well. So maybe picking areas of the country, Rob, and football teams is what we should just stick to from now on.
I think that's probably a good rule. Let's see if we still feel that way come January. But one thing that we will want to keep on doing, of course, is Hub Extra, fitting in a little bit more value before the end of the show in the form of a resource, a tip, something we've been enjoying recently. And Rob, I think you've got something this week.
I have. So regular listeners will hopefully remember, I recommended a AI app a few weeks ago, maybe months ago now, time does fly, called Whisperflow. And Whisperflow is a dictation tool. You're just talking to your computer. It also works on the phone, not as good on the phone, but amazing on your desktop or your laptop. And I just rabbit on all day at my computer. I've even got comfortable doing it in public spaces now, like coffee shops and things like that. And I will talk at my computer. That ramble of words is going into my AI platform of choice, and it's been a game changer for me from a productivity point of view. In fact, when Whisperflow said it's time to upgrade because you've maxed out the free version, it took seconds to make that decision. My bank details were in, and I was paying for the premium service. But I recently discovered a platform that is completely free, sits locally on your computer. You can get software updates to keep upgrading the quality of it, but there is no catch. It's free to use. It's been working really well for me. Does it have the UI interface as friendly as Whisperflow? Not quite, but I'd say it's an 8 out of 10. The accuracy, to me, seems like it's exactly the same thing. I mean, if you really get into it, Whisperflow is probably built on top of the same technology. It's just a platform after all. But this one, Fluid Voice, is free. I've been using it for a few weeks now. I didn't want to recommend it until I'd given it a proper run. But if you're not using an app like this, you should be. Check out the free version of Whisperflow or go and download Fluid Voice. The setup is slightly harder with Fluid Voice, but with a little bit of effort, and I mean just a little, it's not hard, you'll be fine. If you're techie, it'll be a breeze. If you are a bit of a noob when it comes to AI, just persevere, just search for how to set it up properly. And then once you get going, it will be a game changer. I can't stress enough the difference that these apps have made to me, and I'm sure they'll make a big difference to you as well.
Yeah, whatever you use, talking over typing is such a game changer. And piggybacking on that a bit, not quite the same thing, but the new ChatGPT voice mode is so unbelievably good. Rob, I was going on about this to you the other day, but I think it's worth saying if you haven't used ChatGPT's voice mode in a while, it is just so ridiculously good now. It does make me a bit concerned that we are all just going to become progressively more insane, going around seemingly talking to ourselves on our AirPods, being ever more isolated from each other. But at the moment, I don't care because it's just so good.
And you know what else is good? Coming back to this podcast week after week. We will be back on Tuesday with Ask Rob and Rob, so make sure you join us then. Of course, we'll be back with the pod, same time, same place next week. And you can find us in the Sunday Times, smiling back at you, answering your questions there. So however you choose to have your fix with us, do lap it up. So until we catch up with you in one of those lovely formats, take care, have fun, bye-bye.
Bye-bye.